Now that we've finished the profit and loss projections, we move on to the cash flow. We open up a new sheet and call it cash flow. On this sheet, we'll work out our cash flow projections for each month. Essentially, these are what we think our bank balance will be in the future. So first thing we do is we title it, and we move on to year one. And we're going to do this for every month. So there's going to be 12 months for our projections for year one. Okay, the next thing we need to do is put in our seasonality factors. Great idea to put in your seasonality factors because almost every business has some sort of seasonality to its sales. So this allows you to reflect that in your cash flow projections. Of course, all your seasonality factors should add up to 1, and we reflect this in the total column. But it's a good idea to have a check there, so you know that your seasonality factors actually add up to 1. So we set up a formula that takes into account all the cells that our seasonality factor will be in, and to see if that adds up to 1. So we'll start off here. In month 1, we'll say our seasonality factor is 0.02. In month 2, we'll say our seasonality factor is 0.03, and so on for the 12 months. But at the end of the 12 months, it's crucial that all the seasonality factors add up to 1. Okay. And once we've completed that, we see that all our seasonality factors do in fact add up to 1. Once we've this done, we'll move on to looking at our inflows. That's money coming in. And the money we've coming in at the moment is our sales. So let's multiply the seasonality factors by the sales figure that we've got in the profit and loss account. We just imported that figure in from the profit and loss account. So there we have our sales for each month. Now we must move on to our outflows. That's money going out. That's the expenses that we pay for in that particular month. Go to our profit and loss. It's quite easy, just select rent and rates, and we can import all the figures in because they're all nicely lined up. So it's just a simple drag operation here, and we get all our expenses into our cash flow. Remember, our depreciation, we don't have that in our cash flow, so we have to get rid of that when we come to looking at it. So remember that for future times. Okay, now what we're going to do is we're going to look at the profit and loss account, import the figure in for rent and rates for year 1. So we have that. Now we're going to assume that our rent and rates are not seasonal. We pay the same every month. So it's a simple calculation. It's the total rent and rates figure we got from the profit and loss divided by 12. Okay, next is our marketing. Now we'll assume that our marketing is seasonal, that we spend more on marketing in our peak season. So we want to reflect the seasonality factors in our marketing. So we'll grab the marketing figure for year 1 from the profit and loss projections, and now we'll multiply that by the seasonality factor for each month. you'd have noticed that when we scroll to the right, we sort of lose track where we are. Our outflows and our inflows, they disappear from the screen. And as a result of that, it's pretty awkward to see where we are. So what we do is we highlight a column and click freeze. Now I'm using OpenOffice to do this, these financial projections, but the same function is available in Excel and Google Docs and other spreadsheet software. Here's another example. When you're doing the cash flow statement, you need to understand when you pay your expenses. For instance, our light and heat, we pay it every 2 months. So we just have that appear in our cash flow every 2 months. Likewise, you'll have other expenses that only occur once a year, and it's important to show those expenses in the month that those particular expenses occur. So what we do now is we get our total inflows, simply add all our inflows together. And we get our total outflows, and we add all our outflows together. It really is quite simple. Now we move on and we have to find our total inflows or our total outflows. So we do this by subtracting the total outflow from the total inflow. This gives us the inflow or outflow for each month. Now what we have to do is create a rolling balance so we can see our balance for each month. This is very easy to do. First thing we do is we put in our opening balance, which is the balance from the previous period. So we have 0 at the moment. Then we have our closing balance, which is our total inflow or outflow for a particular month, added to our opening balance, and that gives us our closing balance. Now the opening balance for the following month is the closing balance of the previous month. So we'll just set it up like that. Opening balance for month 2 is the closing balance for month 1, and so on. And the most important figure for us that we're going to put in our balance sheet is the year-end closing balance, which is the closing balance at the end of month 12. So that's our simple cash flow. We're going to look at a slightly more complicated cash flow in the next video.